Hi, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 67, titled, Should We Add a Short Put to Fund Our Collar Trade? We're going to use a real life example with Nvidia Corp, which trades on the New York Stock Exchange, on the NASDAQ Stock Exchange under the ticker symbol NVDA. Let's first start by defining the term collar trade. Now, a collar trade is actually a covered call trade with the addition of a protective put. So there are three legs involved in a collar trade. First, we buy the stock, so we're in a long stock position. Then we sell the call option. We're short the call. That is our covered call position, long stock plus short call. But then to make it a collar trade, we add in a long protective put. So we're buying a put. So those are the three legs of a collar trade. Now, the question in this particular podcast is whether or not we should add a fourth leg to the collar trade, and that is to sell another put to help fund the cost of the protective put. So let's first break it down with a real life trade that Jim was good enough to send to us, a trade that he executed with Nvidia. And on October 9th, 2018, Jim purchased 100 shares of Nvidia at $264.24. There is the long stock position. He immediately then sold the slightly out of the money 265 call option and generated a return of $14.45 per share, $1,445 for the entire contract. Now we have our covered call trade, long stock plus short call. Now, Jim decided he wanted some downside protection of this trade, so he then purchased on the same day, October 9th, the 250 out of the money put at $8.20. So now we have a collar trade. We're long the stock, we're short the call, and we're long the put. But the put costs $8.20. So that takes away from the original premium of $14.45. So what did Jim do? He then sold the $245 out of the money put and generated $665. So $665 negated a good portion of the $820 that cost regarding the protective put. So if you were actually to break down the now four legs of this trade, on the upside, we have a covered call. We're long the stock and we're short the call option. On the downside, we have a bear put spread. Now, many of you don't do spread trading. It's not really important, but that simply means that we're long one put and short another put. So that's how the trade was structured by Jim. Now let's have a look first at the covered call aspect of the trade using the multiple tab of the Ellman calculator. Okay, so in this particular situation, Nvidia was purchased at $264.24. The very slightly out of the money 265. It's actually, I would call it near the money, almost at the money, but near the money. 265 call was sold at $14.45. Now, once the blue cells on the Ellman calculator are filled in, the white cells become populated, and we can see that the initial time value return on the option, or ROO, was 5.5%. This is a 1-month trade. Upside potential, 0.3% if Nvidia moved from current market value of $264.24 up to the $265 or beyond that strike price. So there's an opportunity for a 5.8% 1-month return. That's how Jim structured the covered call aspect of the trade. Now we're going to turn to the BCI Collar Calculator, because this is where the protective put was added into the trade. So in addition to the 264 0.24 cost of the stock, and the 250 added, the 265 added the money call strike, we're now going to add in the 250 added the money put for 820. So the results from the BCI Collar Calculator are as follows. The initial time value return is reduced from over 5% to 2.37%. And that's because we have to deduct the cost of the protective put. Now, if the price of the stock moved to or higher than the call strike, our 1 month return on this particular collar trade would be 2.65%, about 3% lower than had we not put in the protective put. If the price of the stock moved below the put strike, worst case scenario in this trade is a loss of 3.02%. So therein lie the advantage of the protective put. We could lose no more than 3.02%, no matter how far the price of that stock declines. And that, of course, goes without any position management. Now, if we added a short put to help fund the cost of the long put or protective put, here are the advantages. By generating a premium of 665 by selling that put, the 820 cost of the protective put is now reduced to 155. So our initial calculations then become a 4.9% 1 month return. So it just about doubles. This is the advantage of funding the protective put with an additional short put. But there are some negatives, as always, with every aspect of every trade we make, there are pros and cons. Now, listen, by selling the deeper out of the money put, the 245 strike, we are now incurring additional risk to the downside. So if we're agreeing to buy a stock at 245 and we deduct that 665 premium, that means we could lose on that leg $238.35 per share. Of course, that's if the stock goes to zero, which we would never let that happen. But the point here is that we're adding in additional risk to a trade. And why did we buy the protective put in the first place? To eliminate risk, or eliminate a lot of risk. And here we are now adding additional risk. Does that make sense? Now, of course, there would be some exit strategy maneuvers if the price of the stock started declining by that amount. But it's important that we quantify and understand the risk that we're undertaking by getting paid to sell another put. We have to make a determination based on all the pros and all the cons, not on just the pros. Let's summarize. When we establish our covered call positions, we must define our personal risk tolerance, and then we could set up our trade accordingly. Some of us may require the additional protection of a protective put. There's nothing wrong with it. But we must understand that overall, it's going to reduce our returns because it costs us money to get that insurance policy. And so that doesn't make it right. It doesn't make it wrong. We have to make a decision as to whether or not what's right or wrong for us. Now, if a short put is added to mitigate the cost of that protective put, we will then be adding additional risk to the downside, as I said before, which is what we were trying to eliminate to begin with when we purchased a protective put. So in my humble opinion, that does not make sense. So before I go, the multiple tab of the Ellman calculator, which I alluded to in this podcast, you can all get a free copy of the basic version of the Ellman calculator on our website, www.thebluecollarinvestor.com. Just look at the black bar at the top of our web pages and click on that free resources link. Also, have a look at our Beginner's Corner tutorial on the top right, which are 2 8-part video tutorials, one on covered call writing, one on selling cash secured puts. They're free, and you can download the PowerPoints also for free. We have a huge library of articles that I've published over the years as well available to you. You could use the Google search tool for any particular topic you're looking for. And check out our blog page where you could sign up for our free weekly newsletter, which I spend hours a week writing, all with educational value, and they will be delivered to your email box 10 a.m. Eastern Time every Sunday morning. Also, have a look in our store, www.thebluecollarinvestor.com/store, where you can get enhanced calculators, where we have online video tutorials, streaming DVD programs, also with downloadable workbooks. We have multiple versions of our published books, ebook versions, soft cover versions, and a few are also available in hardcover format. We also have a trade planner and online mentoring programs available in the bluecollarinvestor.com store. I want to thank you folks for taking the time to listen to this BCI podcast number 67, titled, Should We Add a Short Put to Fund Our Collar Trade? I hope you found this podcast interesting, and more importantly, I hope you will benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.